Okay, good morning, everyone. All UPSC students who are appearing for prelims and mains examination. There's a latest policy revision. In other words, we don't say that it's a policy revision because the rates of monetary policy tools have not yet been changed. But Monetary Policy Committee of Reserve Bank of India, which is basically meant for fixing target rates of various tools that are used in controlling money supply, etc., has been announced recently. So that is on December 4th, 2020, monetary policy revision methods, revision policy rates have been announced, but most of the rates have not been changed. But in this regard, being a civil servant, being a civil services aspirant, you must have a clear idea as to exactly what is this monetary policy, what is this monetary policy committee, what are the current rates. So you need to always keep yourself in touch with the current happenings in the Indian economy. As you all know, in the latest exam, many questions in Indian economy have been directly indirectly connected with current affairs. All right, so today my next 30 minutes class in this live session is basically meant for explaining about monetary policy raising details. So I will go logically, what exactly was announced by Reserve Bank of India, then I'll give you background story, and I'll also briefly explain the rates that are referred in monetary policy. All right, so this class objective is basically to give you the details about latest changes, if in case there are any, and the latest announcement by Reserve Bank of India's Monetary Policy Committee. And also, I would like to give you briefly exactly what is monetary policy and what are its objectives. And I also will give you information related to Monetary Policy Committee and latest updates. So have patience and let me logically explain and bring it to you. Those of you who have come from science background and those of you who have not heard about this monetary policy, even then you will be able to understand, because I will try my level best to give you all the basic knowledge that is required. Next time when Reserve Bank of India comes up with the new policy changes, you must be in a position to understand this. That is the point. Okay, all right, now get ready. So this one, the latest policy highlights of the Reserve Bank of India. If you could see, this is the table I wanted to show you here very clearly. The policy tools, we have got repo rate. Reserve Bank of India, as a part of monetary policy, it has got quantitative tools and qualitative tools. And let me talk about here quantitative tools, because qualitative tools regarding the latest policy did not announce anything. So we have got repo rate, we have got reverse repo rate, we have got marginal standing facility, we have got bank rate, we have got cash reserve ratio, we have got statutory liquidity ratio. Go slow now, please. I mean, as a part of monetary policy, first of all, you would ask me one question, sir, exactly what is the objective of monetary policy? Primarily, monetary policy main objective is to increase economic growth and bring in price stability. If they ask you straight, primary objective of monetary policy, which is basically implemented by Reserve Bank of India, as and when it is required. Previously, twice in a year they used to announce, but nowadays almost monthly they are making an announcement, or once in a quarter also they are making an announcement, as and when it is required. As of now, today, the current scenario in the country is this. So monetary policy, which is announced by Reserve Bank of India, which is a central bank of India, which has the power to control money supply, which has the power to control money and banking system in the country, will announce something called monetary policy. This is also called as credit policy or money supply policy, which is mainly targeting to bring in stability in prices. When we talk about prices, basically we talk about inflation. The constant rise in prices is generally called as inflation. That is, simply speaking, for a common man, if you want to understand in a common language, we call price rise can be depicted in the form of an economic term called inflation. So ever since COVID-19 started, a lot of issues when it comes to aggregate demand and a lot of shortage, supply bottlenecks, so many things, demand, supply, both were affected very badly, because of which there was a shortage of goods and factory production was affected very badly. Manufacturing sector was badly hit, service sector was badly hit. So obviously it's a common phenomena when this kind of a situation occurs in any economy. India is not an exception. So don't think that as if this happened to Indian economy only and other economies are not. Every economy across the globe, including USA, has been affected very badly. So therefore, this monetary policy main objective is to ensure if the prices are increasing, we need to control the prices, and thereby we can bring in economic growth. Okay, that is the point. Okay, now before I explain these rates, let us first go ahead with what is monetary policy, what is the objective, what are the general objectives. All right, look here. Yes, monetary policy. If you look at monetary policy, objectives of monetary policy here I have given. The primary objective of monetary policy is basically what? Economic growth and price exchange rate stability. Remember this point very clearly. If in case inflation is very high in India, general tendency I'll tell you, in India, prices increases because of the demand side problems. That means there's a lot of demand, and there's a lot of demand because there's a lot of money supply, and there's a lot of money supply because of credit facility extended by commercial banks. So when you think there's an inflation prevailing in the economy, it is because of the demand side, and demand is because of the lot of credit supply, and credit supply is because of commercial banks. So you need to control commercial banks which are pumping a lot of money into the market. All right, so if you want to control that, you need to have a policy called monetary policy. Thereby we can ensure economic growth as well. Other miscellaneous objectives, apparently you can say that promotion of savings and investment. Obviously Reserve Bank of India will talk something about interest rates in monetary policy, and these rates will definitely control money supply. Sometimes these rates will be reduced in such a way that money supply will be increased if in case economy needs a lot of money. And sometimes if this money supply is very high, these rates could be increased. So the tools that are used in monetary policy, such as we have seen bank rate or repo rate or SLR or marginal standing facility, whatever, all these rates will be increased if RBI intention is to control money supply. This controlling of money supply question comes only when the inflation rate is very high, and inflation is more because of more demand, and more demand is because of more credit supply. End of the day, you need to control commercial banks. To control commercial banks, obviously what you're supposed to do, you have to control money supply. That is monetary policy through. So savings can be encouraged or discouraged depending on the interest rates, and imports and exports control. All right, so money supply will have direct indirect influence on all these activities. We wanted to manage business fluctuations, trade cycles, ups and downs. Like you must have heard about depression in the economy, recession in the economy, boom in the economy, recovery in the economy. These are all business cycles that we normally come across. Okay, and we wanted to regulate aggregate demand. Sometimes aggregate demand will be spiraling, and good supply will be very less. So sometimes demand exceeds supply. When demand exceeds supply, definitely prices will go up. When the prices are going up, we will definitely call it as inflation. So we wanted to control what do you call aggregate demand. Normally, if you want to create aggregate demand, we have another policy called fiscal policy, that I will take it up in the next class. And if you want to regulate aggregate demand, because of aggregate demand, prices are increasing. Simple funda you understand. Why prices are increasing? Because there's a lot of demand. Why there is a lot of demand? Because there's a lot of money supply. Why there is a lot of money supply? Because banks are lending a lot of credit. Why banks are lending a lot of credit? Because banks are finding it easy to get money from Reserve Bank of India. So ultimately the switch is in the hands of Reserve Bank of India. Switch is in the hands of Reserve Bank of India. Are you listening to me? Switch is in the hands of Reserve Bank of India. So if you want commercial banks to stop pumping or infusing a lot of money, which is ultimately eventually leading to increase in demand, thereby it is leading to increase in prices, you are supposed to control, being a central bank of India, that is RBI, first the commercial banks which are pumping hell lot of money into the market. Usually these are the general objectives that Reserve Bank of India governor, while he formulates a monetary policy, keeps in his mind. Employment is one more thing. That means, why do you think, see, monetary policy can be cheap monetary policy, dear money monetary policy? If the rates are very high, it is dear monetary policy. If the rates are very less, it's a cheap monetary policy. So I decrease rates to pump more money into the market. When I pump more money into the market, where is it going? It might go into the hands of business people. When it goes into the hands of business people in the form of loans or capital, etc., they will definitely enhance the operations of industries. When the industrial operations or manufacturing activities are increasing, definitely number of jobs will increase. See, you will not escape in UPSC examination. You will not escape a question from monetary policy. You will definitely have a question on monetary policy or related to Reserve Bank of India. Once and for all, if you have understood basics, it is not sufficient. I'm telling you, it is not. In economy, what generally happens is, unless and until you come from economics background, it is difficult for you to reassess and re-understand this. So therefore, you have to go on having a grip on this particular subject. Remember. Priority sectors are basically agriculture sector, small scale industries, export sector. So when government wanted the lot of credit to be provided, lot of credit means loans to be extended to priority sectors such as agriculture, small scale industries, export sector. So rates of interest rates have to be little reasonable, so that banks will be in a position to lend a lot of money, and RBI should help banks to RBI should lend money to commercial banks, so that commercial banks will have a lot of money in their hands to lend money in turn to priority sectors, because priority sectors will or priority sector provide a lot of employment in the country. You're listening to my class, please listen to online classes always either with the help of laptop with a high volume, otherwise use headphones or earphones, whichever technology that you have a proper infrastructure, then you will show interest. Because I'm telling you, nowadays the online classes, or in other words, electronic e-classes have become order of the day. At the same time, you also need to have a better information, better infrastructure. So listen to the teachers who have a lot of experience always. Okay, because technical, like history is there, anybody can teach history, trust me. There are some standard subjects like history, geography, or some polity, basic, constitution related. Yes, you can listen. They're all technical subjects, but when it comes to this kind of subjects, what happens, it is not economics, it is about economy happening. So you need a lot of thought process here. Okay, so apparently what I actually made it very clear, monetary policy in general primary objective is basically what? Economic growth and price stability and exchange rate stability. Exchange rate stability is nothing but foreign exchange rate stability. All right, okay. Now, in other words, sometimes with the help of changing the rates of monetary policy, you can also contribute a lot for the development of infrastructure in the country. And moreover, Reserve Bank of India governor, when he designs or he formulates monetary policy, with the help of monetary policy committee, he will definitely think about the development of banking sector. So if in case this concept I'm taking up, because there is a possibility you may have in GS paper, economy paper, you will have theory questions as well. So make sure that you properly make notes of this. Okay, now let us go to the policy rates here. So current monetary policy, which was announced on December 4th, 2020, that is very recently, the last week only. And this policy has made it very clear the rates which were hitherto were there will continue. That's why I gave all the rates as status unchanged. This is one thing you have to remember about the monetary policy that is announced in December. So that's why I have given a crystal clear before this policy, what was the story? Post this policy, what was the story? Repo rate. Briefly, let me give you an account. It is not a waste of time when you're listening to these classes from whichever mode. It is not a waste of time. I'm giving you thorough knowledge of the recent RBI policy. Repo rate is the rate at which RBI lends money to commercial banks. Is the rate at which RBI lends money to commercial banks, generally against government securities. Simply speaking, RBI might lend money in two ways, boss. One is repo rate, second thing is bank rate. Please don't get confused. Bank rate is also called rediscount rate. I repeat, Reserve Bank of India lends money to commercial banks in two ways. Number one, repo rate at which RBI lends rupees to commercial banks, taking government securities as a security. Simple principle, when you want to lend money, if any commercial bank wants to lend money, do you think that commercial banks will lend money without any security? Collateral securities must. So Reserve Bank of India is not an exception. Just because all the commercial banks are licensed banks from the RBI, or let's say registered banks with RBI, does not mean RBI simply lends money without any security. So Reserve Bank of India lends money with the help of government securities, that is repo rate, and Reserve Bank of India discounts the bill which were already discounted by commercial banks. That means, being a trader, when you do a trade, you must have had issued bills of exchange. Simple. If a seller sold goods on credit, understand slowly, if a seller sold goods on credit, if a buyer is not making a payment immediately, buyer will say, Anna, you please draw the bill of exchange. So seller draws the bill of exchange and gives it to buyer for acceptance, and that bill is going to be paid within 90 days. So the trader who has the bill of exchange, which is signed by buyer who bought the goods on credit, got my point? Yes. Trader who has the bill of exchange, which is accepted by whom? Buyer, when he accepted, he signed on the bill of exchange and he said, I will make the payment within 90 days. So this bill of exchange is in the hands of seller. If in case seller wants money, he will go to bank and take the money in the form of discounting. When we say in a crude language, we can say discounting a bill of exchange is nothing but showing bill of exchange as a security and take loan from the commercial bank. So the trader, who's the trader here? Seller. What did he do? He sold goods on credit to buyer. He sold goods on credit to buyer. Buyer said, I will be making a payment within 90 days. So seller has drawn the bill. Buyer has accepted the bill of exchange. He has sent it back to seller. Seller, if in case he needs money during this 90 days, what does he do? Banks have given a clear-cut facility that all the traders who have got bill of exchange which are repayable within 90 days, they can go to bank and show that bill of exchange as a security and take a loan. Clear, everybody? Yes. So the banks which have discounted bills of exchange and lent money to traders, if banks need money, understood now, if banks need money, banks will produce these bills to Reserve Bank of India as a security. Of course, overall period of time will not be more than 90 days. So trader has got it discounted with commercial banks and borrowed money, and banks will be rediscounting. Bank will be producing those bills for RBI for rediscounting. That means RBI will lend money to commercial banks based on the bills which are already discounted by whom? Commercial banks. So bank rate is the rate at which RBI lends money against the bills which are already discounted by commercial banks. So therefore, bank rate is also called as rediscount rate. Second time lending is happening. First time who lent money on the same bill? Commercial banks. And first time who lent money on the same bills? Commercial banks. Second time who's going to lend money now? Reserve Bank of India. So therefore, bank rate is also called rediscount rate. So 2 points I gave you. So that means under repo, Reserve Bank of India lends rupees, not foreign exchange, rupees to commercial banks on securities, government securities, bonds, debentures, etc. And bank rate is basically the rate at which Reserve Bank of India lends money against the bills. Therefore, bank rate is also called rediscount rate. So repo before policy 4% only. Today also 4% only. Bank rate before policy 4.25% only. Prelims especially here also 4.25, not 55, 4.25%. Unchanged. Status is unchanged. That means if you are aware of previous before December 4th monetary policy statement, what were the policies? The same thing is there. Then reverse repo. When commercial banks lend money to RBI, instead of using the word commercial banks lending money to RBI, because commercial banks lending money to RBI, you might think Reserve Bank of India is a printing machine, has a printing machine, and why Reserve Bank of India will borrow money? See, Reserve Bank of India, when it tries to borrow money from commercial banks, the objective is not that Reserve Bank of India does not have money. The objective is that commercial banks should not have money to lend money to public, because if they have money, they are tempted to lend money outside. Therefore, the demand is increasing. Therefore, prices are increasing. Understood? So reverse repo rate is the rate at which RBI borrows money from commercial banks. Again, they're also securities. And I mean, Reserve Bank of India will sell government securities. When it sells securities, understand this. When it sells security means if Reserve Bank of India sells bond of a government, if Reserve Bank of India sells bond of a government, bond is going, money is coming. It sells when it wants to control money supply. It buys when it wants to increase money supply. So repo is the rate at which RBI lends money. That means it is taking back government securities. Clear? Very nice. Reverse repo is the situation where RBI borrows money. RBI borrows money in the sense RBI is taking money from whom? Commercial banks and giving bond to, so selling is happening. All right, like this. So repo is the rate at which RBI lends money. Reverse repo is the rate at which RBI borrows money. Bank rate is the rate at which RBI lends money against the bills which were already discounted by commercial banks. The same bills which commercial banks have already, against which commercial banks have already lent money, is going to be again used by Reserve Bank of India to discount it. Therefore, bank rate is also called rediscount rate. This, what happens is, economy, the technical jargon, I mean the words meaning will be a bit confusing. Okay, you must have that clarity, because it's very difficult to convert them into a general language, but it's better to convert. If you're not able to convert that into a general language, you will face problem. Subscribes to this channel without fail, please, and all economy updates from my side, from my classes, will be updated as and when there is a major change in the economy. So please do subscribe and click the bell icon also, and try attending all BRICS IAS Study Circle classes online, whichever are given for free, please. Next one we have cash reserve ratio. Look at this cash reserve ratio. Cash reserve ratio, that means every bank, like you see, being a bank, you have got three deposits. Try to understand this: savings deposits, fixed deposits, demand deposits. Am I clear? Every bank will maintain what? Savings deposits, fixed deposits, demand deposits. Fixed deposit is also called time deposits. Current account is also called demand deposits. So time deposits, current deposits, whatever you received. From that, certain portion of money from time deposits, from current deposits, I repeat, from time deposits, from demand deposits. Current deposit is also called demand deposit. Fixed deposit is also called time deposits. I'm not confusing. I normally don't confuse anybody, please. I said, being a bank, a commercial bank will maintain three deposits. Basically, savings deposits, a current account, which is operated by business people, fixed deposit, which is operated by anybody, right? Very nice. Time deposit, fixed deposit is also called time deposit. So this is time live. Every deposit that is there with the bank is basically liability, because it has to be repaid. Every deposit that a bank maintains is actually called liability, because end of the day, bank has to refund the money. If you have deposited money in your savings account, so you borrowed money, or bank has taken money, so bank has to repay that money, right? So therefore, every deposit from the banking perspective, it is called what? Liability. So from your time liability means from your fixed deposit, and from your demand liability means from your current account. Am I clear? Certain portion of money has to be maintained with Reserve Bank of India. From which deposits? Don't get confused. Which deposit? Time deposits, and demand deposits. Understood now? Based on time deposits, demand deposits, certain portion, how much here previously, 3% of your net time deposit liabilities must be maintained with RBI, even after the policy, the same thing. So CRR is the amount of money that a bank will keep with Reserve Bank of India. In a simple language, the amount of money that a bank will keep with Reserve Bank of India from or out of time liabilities and demand liabilities. So that rate is unchanged. That rate is unchanged. Clear? Everybody? Next one, SLR. SLR, try to understand. SLR in the sense statutory liquidity ratio. Statutory liquidity ratio. See, every bank is also expected to keep certain amount of money out of the deposits in the bank itself. Supposing if you have received 100 rupees deposit, you are supposed to keep 18 rupees with you. Why? Because this is a liquidity. Liquidity means in banking language, this is a ready cash availability. If in case customer who has deposited money, anytime he would come back and withdraw the money. And we don't know when the customers and what percentage of customers will come back and withdraw the money. If in case customer came back and tries to withdraw the money, if you don't have the money, customer thinks as if bank is bankrupt. So out of the deposits that you have received, 18% of the deposits, understood, must be kept in the bank itself. SLR, statutory liquidity ratio, the ratio which is to be maintained in the bank itself. A CRR you will maintain with RBI, and SLR you will maintain in the bank itself. You may say, if out of 100 rupees, 18 rupees, if I simply keep it idle, what if customers do not withdraw this money? What if customers do not withdraw this money? Then Government of India, Reserve Bank of India says, better you do one thing. If in case you have kept 18 rupees aside in the bank and customers have not withdrawn, I know that this is going to be an idle cash. Do one thing, keep that money in government securities form, like invest that money in government bonds and securities. And whenever you want money, that can be withdrawn, because 24 hours, 365 days, anytime, any day, if you want to withdraw money which is invested in government securities, you can withdraw. So one side, it is not idle. On the other side, it is going to give you some interest from government bonds. If in case you're not interested in investing in government bonds, if you think that customers are withdrawing so much money, then keep it in the bank itself. So every time out of your deposits that you have received, you must keep 18%. So look here now, one more, marginal standing facility. Because you see, from your graduation level, from your +1 and +2 level, from NCERT books, you must have heard these rates. But MSF is something new. MSF and LSF, liquidity standing facility, marginal standing facility, bolke, there are two important rates. You must have a clarity. That's why I have given an explanation here. Am I clear? And that rate also 4.25% before and 4.25% even after the policy. First, remember, policy rates have not been changed in the latest monetary policy, which is announced by Monetary Policy Committee of Reserve Bank of India. Yes. What is this marginal standing? Banks borrow from central bank. Central bank means what? Reserve Bank of India. By pledging means by giving government securities. When commercial bank has a government bond, when commercial bank has a government bond, that is called government security. If in case commercial bank wants to borrow money from RBI, they have to show that as a security in which they have already invested. First of all, you understand why banks have government bonds. Why banks have government bonds, first of all? Because banks have invested money in government securities. Oh, what if the banks wants money now? So show that government bond only in which you have invested as a security, show it as a security and borrow money here. That means when Reserve Bank of India had issued government securities, commercial banks have invested money in government securities. So commercial banks have government securities in their hands. And when they want money, they can show the same securities as a security to RBI and borrow money again. It's like you have a fixed deposit, you will show fixed deposit as a security and borrow money again, right? You don't want to break fixed deposit. Like you have a national saving certificate. So let's say post office saving certificates you have, or post office saving bonds you have, and you want money. Instead of breaking that bond, because you will lose the interest rate, no? If you break that bonds or government securities before maturity period, so you will show that government security as a security. Government security means government bond as a security. Pledge means you will keep something as a security. Pledging means, the word pledging means keeping any movable property as a security and borrow money. So your bonds will be treated as mobile security only, mobile property only. It says banks borrow from central bank by pledging government securities at a rate higher than repo rate. What is the repo rate? Repo is the rate at which RBI usually lend money, rupees, to commercial banks. So what generally happens, banks borrow from central bank, that too under a liquidity adjustment facility, or LAF in short form we call it. So under liquidity adjustment facility, this is another rate. Banks will try to borrow money from central bank. Pledging means giving government bonds which they have as a security. Whereas MSF rate is pegged at 100% basis on a percentage of point above repo rate. So MSF is also additional. So second point is under this RBI lends money only to scheduled banks. Scheduled banks are those banks which are registered under second schedule of Reserve Bank of India Act of 1934. So not every bank which is licensed by Reserve Bank of India is a scheduled bank. Scheduled banks are those banks which are registered under RBI 1934 Act of second schedule. Act of 34 second schedule. So all the banks, you see, banks in the sense all the banks can usually borrow money from central bank, giving government security as a security, government bonds as a security, under which facility? Liquidity adjustment facility, whenever they are falling short of money. Okay, but MSF is something where MSF, marginal standing facility, marginal means additional, extra money you can borrow, because that means indirectly we say every bank has a quota to borrow money. Just because you have a facility to borrow money from commercial RBI, you cannot simply go on borrowing money. You might say, okay, RBI is my father, I'm the bank is child, I will go and anytime make an application. Your own daddy also will not give you money. So MSF is an additional facility given to you when you are exhausted with existing quota. If in case, suppose you are eligible to borrow from RBI under repo or any other facility, some 400 crores, you already are exhausted with that money, means you fully borrowed that 400 crores limit, then you want extra money. Then what to do? MSF. Understood. Look at this. In other words, marginal standing facility rate refers to rate at which scheduled banks, please have this clarity, not all the banks. So ICICI cannot borrow money under MSF facility. ICICI can borrow money under liquidity adjustment facility. Am I clear? Yes. Can borrow funds overnight from RBI against government securities. MSF is a very short-term borrowing scheme. So exclusive short-term borrowing facility that is available for all the scheduled banks. That to rate higher than which rate? Repo rate. If repo rate is how much in our table? If repo rate is, let's say, 4%, MSF rate higher than for repo, you see 4.25 already, the original rate only this one. So under MSF, first question comes, who will borrow money? Scheduled commercial banks. Okay, when will they borrow money? When their existing quota is exhausted. At what rate they will borrow? They will borrow under MSF when they want money for a short term, that too overnight. What are they supposed to do? They have to show government securities, government bonds in which they have already invested. First of all, how come they are in possession of government security? Because they had invested here. Because they had invested. See, big fancy kind of giving lectures will not work. I honestly believe for UPSC aspirant, concept proper teaching, that's it. Fancy kind of, I have seen, full hangama videos like a theater system, and no, I'm just sitting in front of my laptop and teaching, please. That's all. I'm not because my objective is to give you what is needed for you. My objective is not about what background is there, etc. Who will borrow money under MSF facility? Scheduled banks. For what period? Long term or short term? Short term. At what rate? Percentage points higher than, points higher than repo rate. Understood? Yes. One more. It is a window for banks. Which banks? Scheduled banks. From RBI in an emergency situation. Usually what happens, I'll tell you, slowly understand. Usually what happens, so like this it will go. So I'll keep covering I'll keep taking special classes only on certain rates afterwards. Okay, right now, because I thought it's my duty to inform all the, give this information to all the UPSC students, because this is a burning issue. And if you look at the latest prelims paper, there were a lot of questions on banking, financial institution, international trade, etc., etc. So you must, because simply you will get 25 to 30 marks, 15 questions to 20 questions. If you see also 40 marks, each question carries 2 marks. No, 40 marks. UPSC prelims passing is dead easy if you smartly apply smart logic, because current affairs and economy will give you almost 40 to 45 marks. Another 15 marks from static subjects like history, geography, polity. If you take, you are out of this examination, because another 20 questions, 40 plus 40, 80 questions. That's it. Another 20 questions if you're able to answer from static subject. 20 into 2, 40, 40 plus 40, finish. 40 plus 45, 85 marks. Almost you're close. That is a smart technique you have to apply, please. Yes. So it says, when interbank liquidity dries up, usually when bank wants money, what does it do? It will first rely on deposits, but people deposit less and take more money, you know that. What if deposits are exhausted? Next option is they will try to borrow money from other banks at nominal rate of interest. Oh. So first they will try to depend on deposits. If in case they don't have money, next thing they will try to borrow money from the fellow banks, interbank in the sense bank to bank borrowing, right? If that is also exhausted and they don't have money, then they will go to RBI and say, Anna, please lend me money under MSF facility, the rate which is higher than repo rate. And that to which bank? Schedule bank. That to which period of time? Short term only. So under MSF, banks can borrow funds up to 1% of their net demand liabilities. Maximum, like a net demand liability means your current account deposits. Time liability means your fixed deposit. So how much I can borrow? Here also it says 1% extra. Let's say, for example, you already have some net time liabilities is 10% in your total deposit. In your total deposits, net demand and time liabilities is 10%. Another 1% on that you can definitely borrow. Under which facility? Margin overnight lending facility given by Reserve Bank of India to scheduled commercial banks at a rate higher than repo. For a very short term, when you are exhausted with interbank liquidity, means other banks are not in a position to lend money to you, and you already borrowed money under repo, that is also over. All options are over. Marginal clearly says additional, remember that. Yes, understood. This is how exactly whenever monetary policy is announced, you have to create a notes like this and read. Okay. Analysis discussion also I gave. Now this one is announced recently by whom? Monetary Policy Committee. Let me briefly tell you the history of monetary policy and structure of Monetary Policy Committee, which is basically meant for fixing these rates. Like all the tools that we have, like repo rate, bank rate, etc. etc. These tools are actually, target rates are actually fixed by Monetary Policy Committee. After making a policy, it will observe for 7 days. That's why we have a concept in economics called 7 silent days. Monetary Policy Committee will closely go through this, please. Monetary Policy Committee is responsible. So question will be in prelims, like, in the light of recent announcement by Monetary Policy Reserve Bank of India in 2020, which of the following is true with regard to Monetary Policy Committee? You must have seen questions. Anyway, questions, you have an idea. That's how. So it is fixing for benchmark interest rates in India. It is responsible for benchmark target rates. The meetings of the Monetary Policy Committee are held at 4 times in a year. This is one question. Specifically, at least once in every quarter. Common sense, because in a year 4 quarters, 4 times means once in each quarter. And it publishes its decision after each meeting. So basically from this, what kind of question, what does it do? It will fix benchmark interest rate. Then how often it meets in a year? 4 times. Understood? Next one. Committee comprises of currently 6 members and 3 members external members. So it says 3 officials from Reserve Bank of India, 3 from Reserve Bank of India, 3 external members nominated by Government of India. They need to observe a silent period 7 days before and after the rate decision, utmost confidence. They have to observe after making announcements of these policy rates. Monetary Policy Committee, which is comprising of 6 members, 3 members are from Reserve Bank of India, 3 members are external. They will observe confidentially for next 7 days. And Governor of Reserve Bank of India is a chairman ex officio of the committee. He comes only for meetings. Yes. Reserve Bank of India Act 1934 or Finance India Act 2016 has decided to constitute MPC, that is Monetary Policy Committee, bringing more transparency, accountability, fixing India's monetary policy. That means in monetary policy, we have got so many rates. How are you actually fixing the rates? What is the justification in fixing these rates? What is the justification in fixing these rates? Will be decided by Monetary Policy Committee. Monetary policy are published after every meeting. So how many meetings? 4 meetings. The committee is answerable to Government of India. That means if in case inflation in the country, inflation in the economy is going spiraling beyond certain targeted rate, Monetary Policy Committee is answerable and give justification and answers, and immediately it has to suggest measures to control inflation. So the first question you can expect, what does it do? Benchmark interest rate. How often it meets? 4 times in a year. How many members are there? 6 members. How many are from Reserve Bank of India? 3 members. Prelims questions, yes. And how many are from external? 3 members. So after announcing a policy rate, how many days silently they will observe? 7 days. And under what act? Finance Act of 2016. It has Government of India has constituted this one, so that whenever there's an inflation going beyond control, the Monetary Policy Committee is supposed to suggest certain rates so that that will curb inflation. That will curb inflation. So it was actually first, I mean, previously, even from long back, 2002 also it was, 2002, 1988 onwards, there was a recommendation on this, no doubt. But latest Monetary Policy Committee, finalization was done on the basis of Urjit Patel Committee, 2016, Urjit Patel Committee. Yes, composition of current Monetary Policy Committee includes, look here, governor, ex officio. This structure also you have to remember, because you see, they don't ask simply the rates of monetary policy. They will ask you connected. You please smartly go through all the previous UPSC prelims question papers, analyze how they're asking. They don't ask information. They ask related, connected background information. This is what every civil service student has to first understand. You simply know the rates you there. Knowing rates of bank exams. Yes, BSRB, railway exams, bank POs exams are there. No, knowing rates is for them. But for you, being a civil service a student or aspirant, you must be able to analyze connected events. So think, okay, since there's a committee called Monetary Policy Committee, which has announced or did not change any major rates. So what is this Monetary Policy Committee? You have to go deeper into that. They might ask you which of the following is true, or one of the following statement is true with regard to Monetary Policy Committee, which has been in the news recently. Governor of India, next Deputy Governor, Michael Debrata Patra, and we have Executive Director of the Bank, Monetary MK Sagar, Ashima Goel, member of Prime Minister Economic Advisory Council. Yes. Next, Shashank Kabide, National Council of Applied Economic Research Senior Advisor, and Jayant Verma. So 3 are from Reserve Bank of India, 3 are from outside external. These 3, last 3. Clear? So these details also remember. You can't simply members referred from 4 to 6, okay, will hold office for a period of, that means external members will hold office in Monetary Policy Committee for 4 years from the date of their appointment. Understood? None of the central government nominees are eligible to be reappointed. Okay. 25th meeting. Recently, the meeting which was held is a 25th meeting, and that has led to December 4th monetary policy announcement. Yes. That's all. So all this material I will post it across. Please, if in case you are watching these classes outside the ambit, please text a message to BRICS IAS Study Circle. We will post this analysis. The proper analysis also we made. Just go through this analysis and come to a conclusion of exactly what is this monetary policy. All right. That's all for today. Have a nice day. Please do subscribe BRICS IAS Study Circle YouTube channel and press the bell icon. And any doubts, any related questions you have, please do ask us and call us. Our number is 9513333 267. We are there at Hyderabad and Bangalore. Have a good day. Take care. Bye.